They want to crash stocks. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we've got new information that shows the markets are on the edge of a flash crash, and we're going to take a look at what could trigger this massive unwind. Plus, the bond markets have been jittery lately, and we're going to answer the question of what they're worried about. And we've got some data series now that show what could be the catalyst for this flash crash. And last, we've got a follow-up from yesterday's story, some charts you don't want to miss. Let's over to Bloomberg, where we picked today's story up with a headline. JP Morgan's Kolonovich warns of volmageddon 2.0 risk and options. Now, what I want you to understand here is these dealers create these products. You know, a lot of people kind of look back to the great financial crisis and wonder, how did the banks end up collapsing the housing market? It's because they figured out that they could sell insurance on mortgages that they thought was just pure profit because it would never actually be exercised. And so when you look at markets and you look at what dealers do, is they try to create products to make money on, and they don't bother to think of what would happen, just like in the mortgage market, if way too many pile in on a trade and then things go the other way. And what we're going to look at today is what happens when they do go the other way. The explosive rise in short-dated options is creating event risk on the scale of the stock market's early 2018 volatility implosion, according to JP Morgan's Chase Marco Kolonovich. That episode, known as Volmageddon, sparked market chaos exactly 5 years ago and forced the shuttering of one of major volatility-focused exchange-traded products. The latest proliferation of options with zero trading day to expiry has similar potential to create market turmoil. By his team's estimate, the daily notational volumes in such short-term options, known as zero DTE in industry parlance, is around $1 trillion. So what this is just in case you're wondering what a zero DTE option is, it's days to expiry. What it's saying is these options expire same day, and what we're seeing is massive trading volumes in this. And it's not the issue that we're seeing just strictly a lot of people interested in this. What the issue is how the dealers hedge this and what the dealers do when things need to go the other way. Now, Kolonovich's issuing was likely the loudest alarm on zero DTE options, whose explosion since mid-2022 has been often blamed for amplifying moves in underlying assets. Their impact was on display Tuesday when the S&P 500 future swung wildly following an inflation report, making any attempt to figure out the market's collective thinking on the economy an especially futile exercise. So now I want to take you back to Tuesday's chart. We're going to look at the S&P 500, and I want you to see what the impact of these zero DTE options are having on intraday trading. It's staggering. Here you can see on this chart, and when the report issued, stocks went flying higher in pre-market trading, then came crashing down, then rallied back, went all the way down and opened, crashing down into the open, came screaming back higher, came crashing back down, rallied up a bit, crashed down, and then rallied all the way into close. And if you were trying to make any sense of what the market thought of that report, well, you couldn't, because it made no sense. And this is the effect what Kolonovich is saying is having on the markets in intraday trading. But the risk isn't what goes on during the day. The risk is what happens when the dealers sell their hedges. However, should the market stage a big move that put these contracts in the money, that would force option dealers to unwind a large amount of their positions, warns the strategist, who was ranked the best in equity-linked strategies in last year's latest institutional investor survey. On a big drawdown day such intraday selling, he thinks could reach $30 billion according to his models. Those flows could particularly impact markets given the current low liquidity environment. So what he's saying here is, according to his models, in the position where the dealers are showing a profit on these positions, where they're in the money, they would not need to hedge and thus sell the underlying stock. Now that could lead to what Kolonovich is suggesting is $30 billion in equity selling. Now, in a market, when he refers to low liquidity, what he's saying is a market that doesn't have a lot of buyers. So when you have a massive forced selling from the dealers driving price down and no one's in line to buy, well, that means you get a flash crash. And just how bad is this setup? Well, according to Kolonovich, it's pretty ugly. He says this is a new record. Now 50% of options traded expire within 6.5 hours or less. And here you can see on this chart, it's just off the charts. So what does this mean? This is all speculative trading that's going on here. And people are taking intraday bets on the market. If they make money, they do. And if they don't, they lose their premium. That's the risk we're taking. And what he's suggesting, again, if we see these positions and a lot of them move into the money, the dealers are going to pull the rug out from under it and send the markets crashing, and that could have a knock-on effect and something we talk about on a regular basis on this show. And since zero DTE is just a tip of the derivatives iceberg, Kolonovich warns that one should take into account that these flows would trigger further one-way flows from monthly option hedging, as well as volatility control strategies and CTAs. These are those computer trading programs, particularly in the case of a large down move. And so what we've noted in the past on this show is that machine positioning, when they see a large move down in the markets, even though they typically look at closing values, they have fail-safe mechanisms that say, hey, if the market moves down a whole bunch and we're not expecting it, well, then you need to sell too. And next thing you know, you have selling begets selling, and you have what sets up to be a massive flash crash as everybody takes the market lower. Now, many people keep wondering, what can I do to protect myself against this? Well, it's simple. If you are a trader, then you can use stop losses on your trades. If you have a portfolio, you can either worry about this risk by de-risking your portfolio, take it down a notch or two, or you can just ride through it depending on your situation. Another way to do it is to know how the machines are positioned, and that's where CTA Timer Pro comes in. Now, many people have written and said, hey, Steve, I'm not sure exactly how to use this report. Well, let me give you a quick look, because back, you remember, this report called gold going higher, higher, and higher. Well, now looking back to February 6th, it started selling off its gold position off the high there, and now you can see in today's report, gold is a max short position on these fast algorithms and going down towards a small long position on the slower ones. So what the report is suggesting, faster than you'd get from some other signals, is take some profits here, raise your stop loss level, and protect yourself. Now, several people said they missed out on the coupon. They tried to buy it, but it was gone. So I've added a few back. If you've been looking, $20 with that $10 off coupon takes it down to $20. There's only a few left. Grab it while you can, because now Congress needs to act soon to avoid catastrophic U.S. debt default, according to the Congressional Budget Office. Now, what we've noted here is the bond market has been rather nervous the past couple weeks, trending down in price, higher in yield. But what's really driving that is everyone's saying it's the fact that the Fed's likely to raise rates. Well, maybe it's not the Fed in this case. Maybe the bond market's nervous about another event. The CBO stressed in its report this projection is uncertain because the timing and amount of revenue collected and money spent could differ from its estimates. For instance, as income tax receipts in April come in lower than expected because of last year's stock market downturn, the extraordinary measures may be exhausted sooner. And here's the part the bond market's worried about. The government could run out of funds before July. The Congressional Budget Office expects to revisit this projection in May after the current tax filing season. So what you have the case is that perhaps Congress now is going to have to act sooner than they want. In addition, the CBO estimates that inflation-adjusted economic growth, get this, comes to a halt in 2023 because of the Federal Reserve's rate hikes. I'll agree with the first part, that growth is coming to a halt in 2023. I'm not going to agree that has to do with the Federal Reserve. It expects inflation to decline this year, which I agree with, and that unemployment rate to rise through early 2024, reflecting a slowdown in economic growth. Well, I'm going to give the CBO some different charts to look at when we get to the end of the show as a follow-up from yesterday. You don't want to miss those, because it's going to validate we are indeed headed to a slowdown, and that yes, the unemployment rate is likely to rise. But what could trigger this zero DTE event that Kolonovich is worried about? Well, maybe it's the jobs market. As jobless claims remained nearly steady last week, this from the Wall Street Journal, as workers' filings for unemployment have held low levels in a solid labor market. So here's a good side of the story, is that the reason you're not seeing the market sell off is because the labor market is strong. We'll look at a chart here in a moment, but it's very, very rare at this point that we would see a massive sell-off or bear market at this stage. But let's take a look at this report, and then we'll look at the chart. Here we can see initial claims only down 1,000 to 194, again, underneath that critical 200,000 print and well below the average of low 200,000s. We see continuing claims ticked up about 16,000, but still remain at a very healthy 1.7 million. The concern is total claims are breaching and getting close to that 2 million mark. But here's the chart that I want you to see, and there's more after this one, but I want you to note that this is a 4-week moving in initial claims in blue against the Wilshire 5000 or total U.S. stock market in red. It's not until initial claims really start to rise that we see equity markets start to come down or off their peak. It happens every time here. So the notion that we're about to see a major sell-off in the market, not just yet, but if that should happen and the dealers are in a position where they need to unload their positions because their option contracts are in the money and they start to sell, well, now all of a sudden you see how that alone, how a big increase in unemployment claims could be the event that triggers an unwind. But another thing that could happen, well, it could be an unexpected move by the Fed. As Fed's Metre says she saw a compelling case for a half-a-point rate hike. At this juncture, the incoming data have not changed my view that we'll need to bring the funds rate above 5% and hold it there for some time. Indeed, at our meeting 2 weeks ago, setting aside what financial market participants expected us to do, I saw a compelling economic case for a 50 basis point increase, which would brought the top range of to 5%. And again, this is what markets hate. It hates absolute uncertainty. So you have Powell come out and then follow up at the economic club saying, look, we're 0.25%. We're probably going to hike, but likely at 0.25%. And then Metre comes out and says, hey, you know what? I wanted 0.5%. And the market doesn't like that kind of uncertainty. So again, it can take just a little bit of a move to trigger now a massive unwind due to these large number of daily options contracts being traded. But now let's go back to yesterday's story of retail sales, and I want to show you why the market is likely to head lower at some point unless the data here changes in a big way. What we can note is advanced retail sales. Here is this. We talked about this chart yesterday, but now I'm subtracting off the retail sales, the consumer price index, both on a year-over-year rate of change. And what I want you to see here is that as retail sales fall faster than the consumer price index, this is what this chart is showing, that you tend to get recessions. This happens every time, with the exception of around 2015, 2016, where largely believed due to China pulled the global economy out of what was expected to be a recession. Here you can see it again, and here you can start to see it, but this next chart will blow you away. I wanted to compare this to the total U.S. stock market, and before I could adjust it, I had just put it on the data series. It copied the year-over-year rate of change, and look at this. You see the Wilshire 5000 now in red, and when you see, of course, the retail sales less the CPI turn negative, what happens is that means the stock market on a year-over-year rate of change, it too starts to head lower. We see that happen every time, putting some question here and some risk is this rally sustainable, or is it just a temporary rally that I believe will happen as rates from the Fed go, or the Fed goes to a pause or even cuts rates before then the market figures out that everything is in bad shape? Well, the labor market, when we overlay it on that same chart, says, yeah, that's coming. And here you can see when we now put the 4-week moving average of initial claims over the retail sales less CPI chart, that sure enough, as that slows down, you can see the the initial claims data heading higher. We see that validating every time, except now we haven't seen it yet. Of course, we note that employers are hanging on to their employees. The only question remains is how much longer, and if anything, if Kolonovich is right, we do see a flash crash, well, that might be enough to scare employers into cutting some more heads. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.